Thanks, Lee, for the intro. And thanks a lot to my colleague, Grania Henson, and the team at Future Power for inviting me to speak today and also to organise the event. And it's a great venue. I've never been here, but I'll definitely come back if I'm invited. So look, the topic I'm going to cover today is raising debt finance raising debt finance for multiple purposes, being acquisitions, expansions, and management buyouts. But all really, we all look at those in the same way. And look, as Lee said in the intro, myself and my team would look at multiple sectors in the economy, but for the purpose of today, we'll try and hone it in on pharmacies and what's really going to impact the people in this room. So before getting into specifics on pharmacies, I just want to spend 30 seconds on the broader role the bank plays in the economy. So as you can see, we're the largest and oldest banks, or around over 240 years. We've lending of about 156 billion at the end of 2023. We're a full service bank, so today I'll be talking about lending, but hopefully there's a lot of our customers in the room. So as you know, we'll do current accounts, FX, asset finance, wealth, and really anything you need from a banking perspective. In 2023, we lent about 3.4 billion to Irish SMEs, and we've been the leading provider for mortgages, SME lending, and wealth products. And we've about 100 billion in consumer deposits. In relation to pharmacy lending, it kind of fluctuates, but at any one time we could have, it's a large range, but at any one time we could have about between 200 and 400 million to the pharmacy sector, which is standalones and groups, and slightly different in all. We consider a group with anything more than one pharmacy. Just moving on to pharmacy lending. So I know there's loads going on the slide, and as you can see, I like pictures. But I've kind of tried to split it into three different areas, equally important. But first one is who. So who is the business? Who are the people behind the business, and the characteristics of those? The diligence process we go through for, or what we need to review to get through our credit process, and finally the structure that we put in place. And I'll be able to cover some of the pieces that Noel mentioned around deferred consideration, and when I speak to that. So firstly, and definitely the most important one for us, is the borrower. So who it is, who's the business, and who are the people behind it. Because for us, I mean, these are the people we're going to be backing and partnering for the next few years. So it is really, I'll get into the numbers in a minute, but it is really about the people in the business. So very obvious, there's a lot of obvious stuff up here, but look, first, experience and qualifications. So has the individual or the business has a track record? Have they managed a business of this size? So for example, if it's someone looking to acquire a pharmacy, they don't need to have owned a pharmacy before, but have they run one? And have they run it over a sustained period? Is it standalone or a group? We'll do both. And to be honest, most of the ones, at least I have seen in the last few months or years, have been standalone. And the reason that we look at them slightly differently is, if it's a group, we look at the combined. So if it's one pharmacy buying another, we look at the combined businesses. So what it does then is it probably gives it does give a greater capacity to borrow or to raise more funding. If it's standalone, it's really all down to the single pharmacy. Is it a leasehold or a freehold? Anyone who's dealt with banks will know that we much prefer freehold properties because it's much safer and we can take the security, but that's not really what's happening in the market. Most of the transactions we would look at would be leasehold. And again, we do both. In relation to leasehold, why it's important is if in part of our diligence, we look at the lease and most importantly, the length of the remaining lease needs to be longer than the term. So than the loan term. So for example, if there's 5 years remaining on a lease, we can't give a loan for 7 or 8. But usually, as part of the transaction, the lease is being renegotiated, so we don't see it. We don't really seem to come up against that issue a lot. Location. So we'll always look at the location of the pharmacy. What kind of market share? Is it open to competition? Will balance of probability, will it retain its market share, will it grow it, the type of GMS income or the proportion of it. Other resources, so does the business or business owner have other resources to bring through rental income, other assets, so that if there's a gap or if there's maybe an unstable period, are there other resources available to shore it up? And then ESG, so this is a feature of all lending, not just pharmacy lending, but we look at what kind of policies and actions are in place to support that agenda. And my colleague Colette will go into more detail on that, so I won't waste any time in it. In my presentation, obviously not a waste of time for your presentation. So we look at the borrower, and then that kind of covers all the more specific areas relating to location, the individuals involved, experience. And you notice I haven't mentioned anything about numbers. So this is where the diligence phase comes in, and this is the easiest way to summarise. What is due diligence? It is just the bank reviewing a business plan, and in reviewing that business plan, it will look at the historic financials and look at the forecasted financials. And what it's looking at is there enough? Is the business generating, or will it generate enough cash to repay the bank loan with a bit left over to meet any unforeseen events? So as part of the diligence, and with Zoom, Teams, a lot has moved online, but what hasn't moved online is the value of a face-to-face meeting and a site visit. So we will always have that as part of our process. It doesn't have to happen first, it can happen at any stage, but it's really important that we meet the people involved. We'll ensure that the necessary registrations are in place. Again, it's not an issue we come up against, because most of the time, anything that comes to us, that's all the compliance issues are in place already. Financial info. So here we're looking at probably 3 years historics and 3 to 5 years projections. And again, we're looking at trying to capture what's the sustainable cash flow in the business. And the past 3 years is usually the best reflection of that. Again, we'll also look at the projections, because there could be some nuances. So one of the things we'd see a lot about sales of pharmacies in maybe the last 2 to 3 years, the exiting pharmacist may have increased their pension contributions. And then there's a reasonable assumption that when that pharmacy is acquired, that the new owners, at least for the first few years, aren't going to do the same. So that's a reasonable adjustment that we can take into account in our numbers. But really, we're getting back to averaging out over the 3 years and reasonable forecast. Is it generating enough cash to pay its tax, to pay investment, to pay the bank loan, and have, again, like I said, to have some left over. There's a few key metrics we look at, not just in pharmacies, but across all sectors. And those 3 would be owner equity, leverage or gearing, and debt service cover. So cash input or owner equity, we look for about 25% upfront deposit to acquire a pharmacy, or for expansion, or for an MBO or management buyout. If it's a group, if it's one pharmacy acquiring another, that number can be less, because there's a level of employed equity in the pharmacy that is, or the pharmacy that's already owned. And then number 2 will be leverage or gearing. So Noel mentioned a few minutes ago about how pharmacies are valued through a multiple. So this is similar. The gearing and leverage is similar to that. So we will take, the bank uses a figure called EBITDA, which is earnings before interest, tax, depreciation, and amortization. It's basically it's profitability plus certain add-backs. And we can lend a multiple of that, so potentially between 3 to 5. So if the pharmacy is doing EBITDA of $1 million, the maximum we can lend on that is about 3 to 5 million. Then on the debt service cover, again, it'll get repetitive, or it is a bit repetitive, but debt service cover is very similar to what I mentioned with the financial information. Is the business generating enough cash to pay back the debt? And the calculation is, we look from the historic and the forecast, we generate a free cash flow number. So business pays all of its obligations, and what's left over. Whatever is left over, call it 100,000, or if it's 130,000 and the loan repayment is 100,000, then your debt service cover is 1.3. So it does need a buffer. And then it's not just 1 year's financials we have to look at. So we look at 3 years historics, look at the forecasts, and like I said, it's all about the sustainable EBITDA position or sustainable cash flow. Structure, this is going back to what Noel said. So very few transactions will happen like a house purchase where you just say, right, here's your deposit and here's the amount and everyone walks away. We see a lot more at the moment is that there's an element of deferred consideration. So, which is really, really good for the purchaser because they're reducing the upfront cost, and also they're de-risking it because deferred consideration can be an exact amount. So it could just be pay $1 million now, pay 500,000 in a year, or the second amount can be contingent on hitting certain profitability metrics. So it de-risks the transaction for the purchaser because anything that happens in that year, or maybe when they get in under the hood, they might see things they hadn't noticed before. There's a chance to reduce the purchase price. For the bank, it is for any funder. It's not that we don't do it, but what I'm saying is it's really important that it's factored in because any kind of payment of deferred consideration for the bank is treated as a debt repayment. So you could think you have to pay back the bank 100,000, but if you have to pay back the deferred consideration in that year, the business also, or we need to show or demonstrate that the business is generating enough cash, not just to pay back the bank, but also to generate enough cash to pay back the deferred consideration. And the reason that we're so concerned about it is that in our experience across other sectors, if the deferred consideration isn't met or there isn't enough cash in the business to pay it, the bank ends up having to fund it. Legal review. So at this stage, we'll be very conscious or very interested in the contract for sale. So that the share purchase agreement in a lot of cases, and really what we're looking out for here is that there's nothing in there that would prejudice the bank. And what we'd find also is that at this stage, we're very much aligned with the purchaser and the borrower, because if we don't like something and we feel that it's weak for us, it's also going to be weak for the borrower. So it's usually not something we fall out over because, like I said, the objectives are aligned. Then after we carry out all our diligence, the next stage, and it's packaged up and sent to a credit team or credit division for underwriting. Maybe some queries back and forth, but at that point or after that, assuming everything is satisfied, we get to a loan approval stage. And then at loan approval, the steps remaining then would be documentation, legal and security, and drawdown. So the loan agreement is probably the key document here because it governs everything that happens with the loan, or all the terms and conditions. So for your rate, your repayments, the term of the loan, the amount, and also any of the preconditions that need to be satisfied before drawdown. At the stage of the loan offer, that's when the bank will appoint a lawyer, and the purchaser and borrower will appoint their own lawyer, and they will interact to close this out. The security and legal, so if any kind of security that needs to be taken, any review of title, that's all done at this stage. If there's a property involved, there'll be a valuation carried out and a review of title. And at the important point, I suppose, in the legal agreement is that, well, it's very important because it tells you exactly what has to happen prior to drawdown. It also governs what has to happen during the life of the loan. So, for example, there could be information requirements that need to be provided every year. There could be financial covenants. And also at loans of a certain scale, there'll be an annual review with the bank or with the relationship manager. I think that really covers a lot I wanted to say. I mean, it's a bit of a short trip around, but I think the key part for me is to highlight things to consider if you're going down this route. And hopefully this has given you enough food for thought. But look, happy to take any questions, and also I'm going to be around for a while. If you're not comfortable or don't want to ask a question, I can chat to you over a cup of coffee.
Thanks very much, Brian.
No worries.
Thank you. Sorry. Is there any questions for Brian? Any questions from the floor?
What's the max term of the loan? How many years?
So I'm going to give an answer now that I'll try not to for every question I'm asked, but it depends. So it depends on the size, it depends on if there's security, but I think if it's a leasehold and it's around 7 years. but it depends.
One more.
Graham, what's your total exposure in the pharmacy market at the moment?
It's about 200 to 400 million.
Okay, thank you.
Thanks very much, Brian.
Thanks, lad.
Thank you.
Sorry.